The institutional capital flow into Asian technology just experienced its most critical repricing this quarter. As the Hang Seng Index plummeted over 2%, weighed down by a significant tech sell-off, the underlying question for sophisticated investors is clear: what changes next? This wasn't merely a bad Friday, it was a systemic reaction to renewed global inflation concerns, dampening risk appetite across the board. When we talk about Asian tech's core moat, it's often defined by its massive, engaged user bases and the integrated ecosystems built around them. Think of the super apps in China, blending social media, e-commerce, and payments seamlessly. Companies like Tencent and Alibaba have historically leveraged this scale for incredible growth, creating significant barriers to entry for new competitors. But that is only part of the story. Beyond the digital giants, there's a vibrant ecosystem of e-commerce leaders like JD.com and on-demand service platforms like Meituan. These firms have built robust logistics networks and localized service offerings, which insulate them somewhat from direct Western competition. Their value proposition centers on convenience and cost efficiency within densely populated markets. Here's where the margin metrics become interesting for the entire sector. While we lack specific company earnings in our context today, the market's reaction suggests an expected hit to future quarterly results. Higher inflation means rising operational costs, from wages to raw materials, directly squeezing profit margins for technology companies accustomed to easier capital and lower input costs. That's not the only signal. The repricing also reflects a higher discount rate applied to future earnings, which disproportionately impacts growth stocks. With central banks tightening, the cost of capital for these companies, and indeed, the entire market, is rising. This directly affects earnings visibility and forces a reassessment of valuation multiples that had soared during periods of easy money. The next signal comes from management's capital allocation strategies. Faced with these macro headwinds, we expect a pivot towards more disciplined spending. Leading firms like Xiaomi, for instance, might prioritize profitability over aggressive market share expansion, focusing on cash flow generation and prudent investment in core competencies rather than speculative ventures. This is a critical shift. Management teams will be laser-focused on optimizing their operating segments. We should anticipate strategic divestitures of non-core assets, increased share buybacks where cash flow allows, and a general tightening of belts. The era of growth at all costs is giving way to profitable growth. For institutional investors, understanding these strategic adjustments is paramount for long-term outperformance. Now look at how the broader sector is reacting within this new macro environment. The global tech sell-off isn't isolated, it's a synchronous movement across markets. Rising interest rates in the US, for example, directly influence liquidity and investor sentiment in Asia. This creates a powerful industry context where even strong fundamentals can be overshadowed by global macroeconomic shifts. The competitive landscape, while still robust, could also see shifts. Firms with stronger balance sheets will be better positioned to weather the storm, potentially acquiring weaker competitors. Furthermore, the lingering shadow of regulatory tightening in China, though less active recently, remains a psychological overhang, influencing risk premiums for major players like Alibaba and Meituan. That leads us to a bigger question regarding terminal risk. The primary vulnerabilities for Asian tech now include persistent cost inflation, which could erode profitability for longer than anticipated. Regulatory pressure, particularly for data privacy and anti-monopoly, remains an unpredictable systemic headwind. Any renewed crackdown could significantly impact investor confidence and future growth vectors. We also need to consider geopolitical tensions as a significant, albeit less tangible, risk. Any escalation could disrupt supply chains, impact market access, and further dampen global risk appetite, especially for capital invested in the region. This is a crucial, often under-discounted, vulnerability that sophisticated investors must bake into their risk models. Looking ahead, the outlook for Asian tech will depend heavily on the trajectory of global inflation and interest rates. If inflation proves transitory and central banks ease up, we could see a rapid valuation reassessment. However, if higher for longer becomes the new norm, then multi-year theses for high-growth tech firms will need substantial revision, prioritizing free cash flow and dividend potential. Upcoming catalysts might include clearer policy signals from Beijing on supporting economic growth, or potentially strong earnings reports from companies demonstrating resilience in a tighter environment. Firms showing strong demand recovery and margin expansion, despite headwinds, will lead the charge. The market appears to be pricing in a conservative outlook, which can create opportunities for patient, discerning capital. For institutional portfolios, this macro shift implies a period of capital rotation. Certain segments of Asian tech, particularly those with less established moats or higher sensitivity to interest rates, may warrant trim consideration. Conversely, market leaders with proven profitability and strong balance sheets, especially after a significant correction, could transition onto a breakout watchlist as structural momentum begins to rebuild. The recent Hang Seng crash highlights the critical importance of a deep, structural understanding of market dynamics, beyond daily headlines. At SR Money News, we equip you with this institutional-grade analysis, helping you navigate complex environments and uncover long-term value. Don't let market volatility shake your conviction without true insight. Subscribe to SR Money News now for our ongoing, exclusive coverage.